Give us a synopsis of where you think your company is and how these earnings reflect that.
Yeah, David, thank you. So as we exit 2019, what we demonstrated was a substantially better service product and excellent productivity, all driven by the women and men of Union Pacific as we implemented Unified Plan 2020. When we look into 2020, we think some headwinds that we had in 2019 are turning into tailwinds, specifically around trade and more specifically around the U.S.-China Phase 1 deal. However, there's still some uncertainty that has to be cleared up. Our main competitor in trucks is still pretty loose in terms of overall capacity. And with natural gas prices so low, there's a significant headwind on coal, although that turns into a real positive as a feedstock into the petrochemical and plastics manufacturing industries.
Well, I'm glad you went there, because before we talk about your efficiency, which I do want to talk about, let's talk about what you're hauling, how much of it you're hauling. How much is coal trailing off? How much is that taking out of your business? And can you make up for it with other products like the petrochemicals?
Yeah, so coal in the fourth quarter and last year, fourth quarter was down double digits, 20 some odd percent. As we look into this year, there's still headwinds against coal. I anticipate at some point it smooths out. In the very long term, there are secular headwinds against coal, and it'll probably continue to decline. But to your point, David, there's opportunities for us to offset that. Plastics manufacturing is an opportunity. The general petrochem industry is the wonderful industry that's blossomed out of the Permian Basin and other shale plays, has both inbound and outbound product opportunity for us. And there's this gigantic opportunity on taking trucks off the highway through our more reliable, consistent, safe service product. And I see a lot of opportunity there for years to come.
Just a moment on the Phase 1 deal with China. What about agricultural products? Because there are some big numbers attached to that deal. And also, by the way, a lot of machinery.
Yeah, there are big numbers attached to that deal. The details talk about $200 billion in purchases over and above the running rate that was set in 2017. So even if a fraction of that comes true, it's growth, which is very attractive. What'll be important is to see China follow through on their commitments, and if they don't, see how the U.S. Uses the effective enforcement mechanism that's built into the agreement.
So talk about the efficiency of your company. I see that the train speeds are up and the dwell times down. How are you doing that, and how far can you take it?
Yeah, David, it's almost across the board. Our train size is up. Our fuel efficiency was 2% better last year. We're doing less work that we don't need to do. We have a better car trip plan compliance. Cars are moving more per day in terms of distance. The service product is better. And how we've achieved that, David, is we've fundamentally redesigned the network. That's reduced work, but in redesigning the network, we've made it more consistent and reliable and simpler. And so the service product our customers are getting is much better, and we've taken work out of the network, which means we've reduced jobs. As we look into 2020, there's plenty more opportunity to continue to enhance the service product. We think we can get freight car velocity up some more. We think we can get train size up some more. We think there's continued opportunity to take work out of the network that doesn't need to be there. And all of that continues to reinforce a consistent, reliable, and efficient service product.
You mentioned jobs specifically. How many employees does Union Pacific have now? And how many of those could be replaced by technology, if I can put it that way?
That's a great question. So right now, think about our employment as something like 36,000 people plus or minus. I won't get the number exactly right, but it's in that ballpark. Of that, technology really impacts a couple of distinct areas. In the cab of the locomotive, we have an engineer who's manipulating the throttle and the brakes and essentially running the train, and we've got a conductor who's supporting that engineer. Technology, both what's available today and what incremental investments off of that platform, will largely make that conductor's job in the cab become less and less important, and their work really will be on the ground supporting trains. So I see that happening. We're also using technology when it comes to maintaining the railroad, both finding defects and then fixing those defects. And we're doing the same when it comes to maintaining freight cars, locomotives. and even in our switching, where we're using technology to become much more efficient at how many cars a particular job can switch.
One last question, and that's pricing power. You mentioned earlier about maybe some excess capacity in the freight hauling from trucks. How much excess capacity is there? At what point, how much growth do you have before you really get more pricing power?
Well, we use pricing as one of the three legs of our three-legged stool to improve our margins. And we always, first and foremost, look to price our service to the value it's delivering and make sure that we can continue to reinvest in our railroad given the returns it generates. In the environment we were in 2019, of course, pricing was difficult and under pressure in some of our markets. Now, the good news is by fundamentally transforming the railroad, we've shifted our cost basis, and markets that didn't used to look terribly attractive to us look attractive to us now. Pieces of business are starting to look attractive to us. So our new cost basis opens up more markets to compete in, and as trucks start tightening up a little bit and some of these other markets start healing, I think there's remains a really good opportunity for us to continue to price to the value that we represent.